Well, hello. It's very nice to be back with you. I'm Nicholas Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. It's hard to believe, but we're already a full week into the new year. Before it becomes too passé, let me wish you and your family one of great happiness, good health, and good fortune. For consumers of national news, the holiday season will seem like ages ago. And of course, while it would be careless to not acknowledge the gnawing persistency of the virus or the escalating political tensions this country faces, with our investor hat on, we're encouraged by the bullish cocktail of an economy that is recovering and transitioning towards expansion while aided by the abundant provision of fiscal and monetary accommodation. For us, this flushes out into two key areas for investors. The first is that despite a strong start to the year for the equity market, we're very likely to find ourselves in an environment where the economy, in effect, outperforms the stock market. And what does that mean? Well, in traditional theory, the stronger the economy grows, the more liquidity gets pulled from financial assets and in turn invested into the real economy. And this works to the opposite effect as well, as we saw in the period following the tech wreck in the run-up to the global financial crisis. And so we watch with great interest as the economy strengthens and continues to reopen, at the same time that the provision of accommodative policy remains at unprecedented levels. And the second, by our lights, this would seem to support a material increase in economic activity, which would likely lead to a backup in longer-term interest rates and ultimately the relative underperformance of risk assets. The key would seem to hinge on inflation and real rates. Will the economy be strong enough to absorb the excess capital, or will growth stagnate and perhaps lead to an increase in inflation? Time will tell. And while the direct implications for your plan can differ, if one follows this reasoning, the natural portfolio adjustment would seem to support an increased allocation to value shares, particularly traditional cyclicals like the financial sector, the industrial complex, and energy patch, while pulling back on growth names, perhaps an opportunity to harvest some of the gains from the strong run in new economy technology and communication stocks. As always, it's important to work with your Baird financial advisor when considering any shift in portfolio strategy, but to us, the economic backdrop appears to support a shift down the capitalization spectrum, away from large caps and towards small and mid caps, as well as a move away from U.S. domestic names in favor of international. Among the non-U.S. equity options we have, our focus is on the emerging economies, with an issue and a bias towards commodity exporting nations versus the manufacturing exporters. Asset allocation can throw a lot at you, but timely adjustments can help inoculate portfolios from unnecessary volatility. So as we turn for home this week, let's stay mindful of the hallmarks that make this nation great. Our reliance on this foundation will help to buttress our minds and our portfolios from the volatility of the moment. Remember, the Baird team is here to help you through. So stay healthy, and we'll see you again next week.